So aside from the job numbers, which we've discussed, remain stubbornly high, and I think most market analysts agree that we've got to see greater numbers, or a higher level of unemployment before the Fed will get comfortable. But there are a lot of other numbers that are supporting a more dovish tone, or that the Fed could take their foot off the gas. Is the data irrelevant? Is the Fed's conjecture and their signaling too hawkish? What should we go with?
That's a great question, Jonathan. So if you think back to last year, beginning of 2022, January, the Fed had predicted 2 rate hikes on the year. Fast forward 12 months later, 7 rate hikes and one of the most aggressive rate hike campaigns in the history of markets. So, what happened, right? Pretty quickly, the market figured out that it wasn't necessarily what the Fed was predicting or what they were saying. They were reacting to whatever the data was saying. Whatever, they were influenced by inflation data, they were influenced by the job data. So one might hope that the Fed could all of a sudden say, you know what, I'd like to go more dovish. In a lot of ways, the market actually is doing that, and they're predicting it. A few times last year, at the end of March, the end of July, the beginning of November, the market reached new highs, basically living on a prayer. They were essentially thinking that whatever the Fed was saying was only going to be determined by whatever the data point said. Another example, as we ended 2022, the Fed data points, the dot plot, all the different regional Fed presidents around the US had basically said that 2023, the final rate for the Fed, the terminal rate, where they stop hiking, was going to be at 5.125%. You look at the Fed futures market, they priced in a 3% chance of that actually happening. So somewhere along the way, the traders say, the Fed is just being influenced by the data points. Whatever happens with these upcoming reports, whether it be inflation, whether it be jobs, whether it be corporate earnings and economic growth, the Fed is going to have to react to those numbers, and ultimately, that is when the pivot occurs. That is when the dovishness occurs. So data is absolutely paramount to start this year. And last year, unfortunately, every time those data points came out, the Fed reacted negatively. And not only was it hawkish, it was surprisingly more hawkish every single time the data came out. So with that, we can only hope that the data does support a pivot and ultimately an economic soft landing.
Kind of going off that, it's a well-known fact that the Fed is kind of driving the car and through the rear view mirror, looking at indicators from the past to try to direct rates for the future, where the market is looking at the future and investors are making decisions based on what they expect to happen in the future. We've had enough data points where inflation is coming down. Is the Fed going to start looking at the trend rather than the latest number? Are they going to combine that trend and use kind of a more holistic view of the data to inform their next rate decision? Or are they just being too kind of in the moment when making those decisions?
I think the Fed has to absolutely look at each data point, each report, inflation, jobs reports. I mentioned earlier the biggest mistake that the Fed has made in the past 40 years was pivoting too soon. It happened in the early 1980s, it happened in the 1970s. As soon as that headline CPI number started to come down, the Fed took its foot off the gas pedal and allowed for economic growth to occur again. That led to stagnant inflation or stagflation. So I think the Fed is very, very headstrong and bound on making sure that doesn't happen again. And ultimately, 2023 is going to be another year of monthly, weekly data points and inflation reports and job reports.
Stonebriar Wealth Management, advisors for your life. This is not an offer.
offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process described herein will be profitable. Investors may lose all of their investments. Past performance is not indicative of current or future performance and is not a guarantee.